Good morning, good afternoon, good evening, whenever you're watching this, wherever you're watching this. Monday market update, Nash Paradise, Matt Gougé, St. Patrick's Day edition. We are going to get you economic mortgage news. We're going to get it to you in a timely fashion. We're going to jam through a bunch of data, talk about what was last week, what's coming up this week, what you should likely expect as far as volatility in the mortgage market. We'll talk our personal beliefs on what's going on in the real estate market and whatever else tickles our fancy. How you doing, Nash?
I'm doing good. Did you enjoy your week off last week?
I did. It wasn't necessarily, I guess it was for a good reason. I was celebrating my oldest son's 16th birthday. Right. We're out of town watching the Sacramento Kings lose a heartbreaker at the buzzer. Down in LA at that new Clippers stadium. So it was enjoyable. It was a good time.
Well, you didn't miss much in the market last week. If you want to, we can go ahead and jump straight into slides and power through this thing, talk about what's been going on and what's going on here. So talk about last week. I had set some alerts on Wednesday of last week. Wednesday was our good, 2-star day, where we had a lot of neat stuff coming with the core CPI for February, month over month and year over year. So we came in just short on both of them, and no one cared. Looking at the actual bond prices for last week and where any of the mortgage-backed securities went, Wednesday was a pretty flat day. The biggest movement that we had last week was actually from Monday to Tuesday. Oddly enough, the market lost a pretty good bit of room then for nothing. All we had was, consumer expectation that hit at that time. So it just showed that, even though the economic news is what moves markets, sometimes markets move on their own. Looking through the rest of the week, jobless claims were close enough. Core producer prices close enough. All in all, it wasn't a very interesting week. Everything pretty much came in as expected. Any thoughts on last week's calendar?
Yeah, since you're the nerd here, you got to explain to me the different color coding here. When I see a red bar versus an orange bar, what's that telling you about that specific piece of economic data?
Yeah, so the reason I like this website and the reason I picked this information for the screenshots is because I can filter the type of information that I want, and I can sort and filter by impact. So that is the impact zone. Red is the highest area of impact, orange is medium, and I took out the light impact stuff because the lighter the impact, the less relevance it's going to have. And people got to remember, we're here to talk about the housing market, what's going on in mortgage rates. And that means that, unless it's a pretty heavy impact, it's probably not going to move the markets with us. But funny enough, some things that are heavier impact for the market is not necessarily as heavy for, the mortgage market. So these are close enough. The consumer price index stuff, yeah, that's going to be heavy for everyone. Everyone cared about Wednesday. And funny enough, like the jobless claims things, if we miss big on jobs, we'll see some pretty good market movement in the 10-year treasury. But since we were flat, it didn't really matter. And I would argue that the producer price index versus the jobless claims, like those should probably be flipped. But, this is good enough. This is what they're showing here is kind of like the market information for all markets, stocks, etc., not necessarily just on the mortgage side.
Sweet. So
Cool.
no huge misses and no huge volatility in mortgage other than the early week. We got a little worse.
Yeah, no, very, very nothing burger last week. But let's talk about this week. This week should be a huge week, right? I mean, we should be really excited and interested in what's happening Wednesday. We got the Fed interest rate decision.
Fed week. Always one that, there's plenty of news around it from people that don't really understand, what's going on. And they're like, the Fed is setting mortgage interest rates this week, right? That's what happens, right, Nash?
No, actually, it doesn't, Matt. The Fed rate has nothing to do with mortgage rates directly. And, I'm sure that our audience knows that, but we care about the Fed interest rate decision week most of the time. We don't today. We've been talking about March 19th for months and months now. March 19th was never going to matter. We got our movement, at the end of last year. We're not going to see the Fed make a decision anytime soon that's going to be lowering interest rates. I think the interesting thing about this week, though, is because we already have Monday numbers. Retail sales came in pretty low, 1.37% off from the consensus mark. We were forecasted at 0.7% increase, came in at 0.2. You're looking at the previous was a negative 1.2. So that may explain why we're seeing some green today. Everyone's been asking me, what are you wearing St. Patrick's Day? Where's your green? Well, my green is in the market. My green and mortgage-backed securities are all favorable. Rates are getting better today. And we can point to the retail sales miss on this for, driving things in our direction.
Cool. Yeah. And as always, I remind people, in case they haven't heard me say it, the last 52 times I've said it, the statement from the Fed in most meetings is going to be more important than what they do, because what they do, which in this meeting will be a nothing. There won't be any rate cut. There won't be any rate hike. It'll just be par. But what they say on Wednesday, I think that means there's gonna be a dot plot too, right? So they're gonna
we're gonna get a full Fed press conference at 2:30 p.m. on Wednesday. So yeah, I'll be tuned into that. It'll be interesting to hear.
Yeah, that's where we're looking to hear from them. If anything has changed from what we've heard in the past, and whether we might need to cut earlier. This might be the new plan going forward, and if that dot plot, which is just where rates are going to be in the future as far as the Fed funds rate goes, if that stuff changes, that's why it's red up there, as far as how much it impacts the market.
I mean, it's Fed week. Anything else going on this week? I'm always interested in housing starts and building permits, because I feel like new construction is what drives down housing costs. If you can build more affordable homes, then resale homes in the area will have to get cheaper. Obviously, we haven't seen those numbers be anywhere near where we need to match supply and demand, but I do like to watch those and see, are we coming close to consensus or not? Those can actually impact decision making by people who buy mortgage-backed securities. So that stuff's interesting. Philly Fed and initial jobless claims at the end of the week, pretty interesting as well. Not likely to make a huge move unless there's anything drastic. I mean, all the consensus efforts is that the Philly Fed is going to come down. Jobless claim should go up just a hair from the previous figures. So there's not a particular target this week where I'm going to say, watch out for this date. Make sure you lock before this one. It should be pretty consistent unless we see any major detractions from the news. But I think we're going to be able to see those coming a little bit in advance. So, just watch the market, watch the mortgage-backed securities, see what the 10-year Treasury bond is doing. When you're a real LO, it's when your watch here has got, the 10-year trade. Oh, it's not going to come through. But there it is. I've got the 10-year Treasury right there on my watch. So
nice. 4.28. Where are we at right now?
4.27. Apparently I'm weird in that. I showed that to someone at a meeting the other day. They're like, why in the hell do you have the 10-year Treasury bond as just going right across your watch face? I'm like, why wouldn't I want to see that all day long?
That's only going to hit in certain circles, but in the circles it does hit, you're in good company, buddy.
Yes, Josh, I'm a nerd. Thank you for that. All right, let's move on slides and see what we got here. We were just talking about this. We've got Fed week this week. That's the meeting date up at the top, and a whopping 99% in favor. Just to give y'all a little idea how to read this chart, this is an aggregated dot plot for the meeting possibilities. So watching, obviously the blue that's highlighted is going to be where the most votes are for these different things. And, right now we're at that 4.25 to 4.5 mark, that one on the far right. So the way to read this is you can say, cool, when do we think the first Fed rate cut is going to be? Well, based on the chart, it's saying we think we're going to be there in June of 2025. 85% say that we're going to have that cut by then. Funny enough, like if you look at July, it looks like that number's gone down, but that's just because we've shifted some of that percentage to a second rate cut by then. So again, consensus, one cut by June, a second cut by September. Matt, do you remember when we were thinking a second cut was going to come just a month and a half ago?
Yeah, for sure. And what really jumps out to me, to be honest, Nash, is that, there used to be, 5, 6 rate cuts on the horizon. Now and that was when we were projecting just for 2025. Now we're like, hey, between now and the end of 26, we're projecting 4 rate cuts, which is 2 a year, which isn't even the number that was projected for 25, call it 6 months ago. So certainly there's been a throttle back on what the expectation on Fed rate cuts would be. But, this is all dependent on economic data that's not out yet. And so we can't say that, you set it and forget it. This is a ever-changing, kind of predictive
100%.
model here.
Well, and what's interesting is, just a month and a half ago or so, the second cut wasn't anticipated until December. Now, the current projections show a very likely cut by the time we get to September. And then getting into like the December, you're almost 50-50 split on if we get a third cut by December 10th. So we've gone from 5 to 6 rate cuts, 4 to 5, 5 to 6, all the way down to 0 to 2, with some Fed members showing 0 on their dot plots. To then a consensus at 2, and now we're starting to work back closer to 3. Yep. So it just shows that the way the economic data is trending, we're actually ratcheting up slightly towards a third cut this year, which the takeaway here is we should continue to see data that supports a lowering of inflation in the way that we want, nice and slow and steady, which would continue to lead to these treasury bond yields dropping, mortgage interest rates dropping a little quicker than what we thought a month and a half ago or so. So, overall good and healthy for the market to have a nice slow decline. But that's how you read this chart. 1 move, 2 move, 3rd move. By the time we get to January 26, highly likely. But then you can't really know what's going on after that. So Wednesday, when we get new dots, this is going to update, and it'll be really interesting to tune in next week so we can talk about the Fed futures and where we think these rates are going.
Yes, sir. We'll do it. Yep. Where are rates at? I think that's the next slide, right? It's just
that's always the good one. The most interesting one anyway. I feel like we've been in this world. So last week I talked about how we dropped just below 675 and just above 675. And I'm really only focused on the Mortgage News Daily, the blue one, because it's the best and it's the most accurate. And looking at my other screen over here, we're showing 6.81, but even then, that was this morning. I think we've probably dropped 3 to 4 basis points since then. Things have improved just a hair. So I think by the opening tomorrow, we'll probably be at 676, 677. Flat, slow, steady. It's been a long time, Matt, since we've gotten just, where rates are and they stay consistent. I don't want to age myself too much, but back in my day, when rates were at 5.5, they stayed at 5.5 for weeks, if not like months. And maybe then you drop to 5.3 and maybe up to 5.6. But we were in a pretty steady spot for a really long time. And I think most people that have been in the industry for the last 4 to 5 years just don't even know what that's like with rates changing that quickly day over day. Wanted to get your thoughts on, could we be seeing a market here this year where we have a lot more consistency week over week?
Hopefully. I mean, I think that it's a better experience for a home buyer, and it's just, it makes things easier in a market that feels kind of tough in other ways, with affordability, with people, stretched a little bit with what they can buy. So I'd much rather have it like this, where if I'm talking to somebody and we're trying to work through, okay, 400 to 425, that's the range where you're comfortable with the mortgage payment. That doesn't change, 2 weeks from now. Like, all right, hold on. Now you're looking from 380 to 405. Oh, wait, hold on. Now you're back up to 390 to 415. The less volatility, I think the better client experience. And ultimately, like that's the client is the buyer client of real estate for me. And so I want what's best for them, which is, less volatility. And really, with rates having come down to 6.75, we're already in a season right now where spring buying market is upon us. More listings are coming on the market. Buyers are moving more. We don't necessarily, in my opinion, want to see rates come down a lot further because it's going to inject more demand than the average buyer wants, whether they know it or not, right? Like if I had a magic wand to make it 5.99 tomorrow, the average buyer would suffer because of it. They would have.
You can speak for yourself, Matt. I'll take 5.99 all day.
All right.
I mean, I hear you. Supply and demand is important. And like we talked about, a couple of weeks ago, rates come down too fast. You get too many buyers. There's not enough sellers out there. I know your market's very, very different there. But
I was going to say, you got more inventory in most parts of Texas than we have in the markets that I'm working. So I can't stand any more demand. It's already competitive enough in different parts of Texas. Yeah, you could take 5.99. It wouldn't cause too much melee and 42 offers on a single entry level house. But yeah, that's another subject that people should be aware of, is that not all markets behave exactly the same. You're going to have a different market based on where you're at.
I think the other good takeaway here with what we just touched on for, mortgage professionals, real estate professionals, as we get into some more stability going forward, it is more important to make sure that your value propositions are out there, that people understand you, because, rate shoppers it's going to be a little bit easier. You're not going to be able to take advantage of swings daily in the market. Oh, hey, you locked last week. Well, we're down 90 basis points today. So, you're selling apples against oranges there. You've got to make sure that you're on top of your stuff up front and establishing your value, being that trusted professional, understanding the markets, and being able to explain how you're setting up your rates, why it makes sense to structure one way or another, understanding where rates are going over the next couple of years. Why are they going down? Why are they going down slowly? What are these projections? And hopefully we gave you some good information that you can just regurgitate, share with your partners, and be that trusted expert. So that way, you're able to capture those clients that really need you.
Yes, sir. Agree wholeheartedly. What else we got? Are we going to let the good people go?
That's all from me. That was my beautiful, brilliant call to action and takeaway, on our abbreviated, let's go get back into selling business. But the other I'd say is don't hesitate to look at refinances. We've been a couple years in higher rates right now. It makes sense for a lot of people, especially some of those VA streamlines, FHAs. Have it on your radar. And if you don't have it on your radar, put those people on your radar. Make sure that they understand that's the strike price that they need. Make sure they know that you're watching. It's still a market where we've got a lot of commission breath out there, a lot of hungry loan officers, a lot of companies that are desperate who've had to slash their margins to be competitive. They need to capture market share. So the competition for refinances is just going to be hotter and hotter. And the majority of your clients don't remember who you were after a year, unless you've got fantastic follow-up like Matt Gougé does. So get out there, have your calls with clients, make sure they know what you're watching for them, explain the refinance process and that you can do them, and just make sure that they know you're going to be taking care of them when the time is right.
Yep. Yeah, for sure. Like the largest lender in the country has got 52% of the loans refinanced. That means something. Refinances are happening, and whether you're part of it or not, as a loan officer, sometimes I think loan officers, you inject yourself and you give great advice and it's not the time to refinance. Or like is in the case with some of the conversations I had last week, Nash, somebody goes, well, I'm going to wait until it gets lower. Rates don't always go down, right? And they don't go down a straight line. It might make sense to look at a refinance that doesn't cost anything right now, that saves you $250 a month, but you don't inject a lot of, cost into that mortgage. And then you do it again in 12 or 18 months. Literally, like the stuff I'm seeing now is exactly the playbook from 19, 20, and 21, where if somebody went from 5.5 to 3, they did it twice, right? They went from 5.5 to 4.25, from 4.25 to 3, and both refinances make sense. You ran the break-even analysis on both of them. They both made sense. And you didn't want to wait to go from 5.5 to 3 and pay that extra 1.25 in interest for 12 or 18 months. So you got to talk to an advisor who can walk you through that. If you're a mortgage advisor, you don't know how to walk somebody through that, work on it. get in the gym and get better at refinance analysis, break-even analysis, and whatnot. So, they're out there, and it's, in my opinion, Nash, just as rewarding as helping somebody get into a home is helping a family save $300 a month, which makes their life better. They can take one extra vacation a year. They can put, their kid in the karate class that wasn't quite in the budget last month. Like, that stuff is rewarding as well. So refinance.
Sure,
for sure. Good point.
Love it, man. Can't wait to get back together next week and see what has happened in that amount of time and keep this conversation rolling.
Yeah, we'll recap Fed week next week and see what came of it. Thanks, Nash. Appreciate you, brother.
Take care.